And Brett, I'm glad you are pausing for this here too, because it took us hearing this a couple times to understand the concept. Obviously, we interviewed you on the podcast, and it started clicking then, and then of course seeing you at Best Ever Conference, and having you go through it a second time, and then actually even sitting through the Q&A there for the third time really solidified it. But the point being, you really get to stop the clock on that shotgun wedding, which I shared my personal experience. I had 2 failed 1031 exchanges in the past year. Ouch. Where, something like this can help prevent that from happening. But, furthermore, you can cross assets. So as you mentioned in that case, obviously real estate into stocks and bonds or vice versa. So just very versatile product.
Perfect. Excellent. So thanks for sharing that. I appreciate that. And so that is the Deferred Sales Trust so far. Sell high, buy low. Sell high, diversify. Sell high, get some liquidity. Sell high, invest dollar cost average. For some people, it means going from active to passive. Some people, it's a little bit of both. I had a client named Chuck, and Chuck for 25 years was in multifamily. And last week he closed after like 25 years of student housing in Tucson, Arizona, managing his own property. He's like, Brett, I'm done. He netted about 1.7 into the trust, deferred hundreds of thousands of dollars of tax. And he's just like, let's get passive. I'm ready to enjoy my life. I don't need huge returns. Like right now, I don't want to overextend. I don't want any more debt. I don't want any toilets, trash liability. However, I want the option, should I get a little bit bored in retirement, right, to be able to go back in. And that's what the Deferred Sales Trust always gives you versus the Delaware Statutory Trust. It's a Delaware 1031. You've got to stay with somebody else, illiquid, huge fees, and not able to go into passive deals that are smaller. So that's for those that are wondering about that. Okay, so let me keep going on this presentation here. In fact, I'm just going to start sharing some deal stories because at the end of the day, I think those are the most important. So here we go. Oh, by the way, I remind you who this is for. Okay, our minimum size deal is $1 million net proceeds, $1 million gain. And it works for cryptocurrencies, NFTs, business sales. We just did a dental practice business sale out of New Jersey. He was a dentist for 30 years, and he sold his practice for about $1.5 million and has an extra $600,000, about 40% extra, to be able to invest into real estate, into the stock market. And that's huge for him, right? It's huge. It's almost double what he would have had, right? And works, of course, for investment real estate. It can save a failing 1031, even past the 45 days, no problem. You're not having to identify the Deferred Sales Trust, although we do need to put it in the exchange agreement, and we have exchange companies that we work with to do this. So make sure that you're working with us on that, because not every exchange company wants you to know about this, nor do they know how to do it. And so you don't want to put yourself in a situation where you have no backup plan, okay? Also, it works for GP or LP interest, again, as long as it's big enough. Primary homes, private stock, public stock, works for carried interest, captive insurance, artwork, collectibles. And this is what's possible for you. This is a client of mine. His name is Shay Pope, and you can hear him on my podcast, share his whole story. And he actually sold a business in Alabama for $2.6 million. He had a couple partners, and he's ready for the next journey. But his next journey was being an active multifamily developer. And I think Adam, you might have met Shay, I'm not sure, at the Best Ever, but he was there.
Yep.
Anyways, he exited his business, deferred about $600,000 of tax, and then he partnered with the trust to become to be active again into an LLC, which he's the managing member of, and he used the funds to build 72 multifamily units, along with his partner too in the bank. I mean, it was more than just $600,000, but the point is, he became with the trust a limited partner into a bigger GP position, and that's just what's possible. So instead of getting $600,000 from the bank, instead of getting it from another private investor, he used the trust to fund it, of which he would have paid the tax to the government anyways, right? Remember, a 1031 cannot happen with the business, but it did for him with the Deferred Sales Trust. Also, he put about $1.6 million with Praxis Capital and about $300,000 with another operator. Here's another deal in Silicon Valley, a primary home for a client of mine. Sold for $8.3 million. So remember, primary homes do not work for a 1031. That's why they're a blockbuster. But a Deferred Sales Trust is Netflix because it can work for a primary home. And that was cool. Here's another one out of Georgia. A client of mine named Dave. And Dave had a couple things he wanted to solve. One, he was ready to start his legacy play, which is a big Montana ranch to help corporate leaders. And he needed his time and his energy to do that. That was more important to him than making more millions of dollars. However, he was faced with a 1031 exchange and about a $1.1 million tax liability. and he didn't want to chase another deal at 7.6. He said, you know what? I want to get out. I'm going to pay off 4.6 million of debt. So he wanted to be debt free to start. He wanted to be tax deferred, and he wanted to be passive, completely passive. And so he put the majority of the funds with the group called Praxis Capital, and he put a big chunk with a group called Ashcroft Capital. Okay, without doing a 1031 exchange, by the way. Remember that these groups, by the way, do not accept 1031 exchange money, right? Like most funds don't, and in fact, I don't know any that do. And so he was able to diversify and do that. Here's another deal in Colorado. It was a $5.1 million sale for a couple out of California. Now, their biggest thing was estate tax. So for any of you that are ultra high net worth above 22 million, married or 12 million single, there's a thing called a 40% death tax. And this is where we can exit the equity outside of your taxable estate. And we can eliminate 40% estate tax without buying life insurance, without having to do any gifting, without having to give it away to charity. Okay. In fact, one of the biggest deals for this was a $125 million deal in San Diego that was audited. Okay. And all no change audits so far. It's been perfect. Okay. Here's another client of mine. They actually live in California, but they sold a $20 million asset in Vegas and another $16 million deal in Phoenix. And they put their GP interest in, and the other LPs just paid their tax. The LPs could have done theirs. Just most LPs are 50 to 150,000 or so, that range, and it's not big enough for the trust. Now, if you had two LP interests at 500 and 500, can we combine those two into one? Yeah, we can to make it $1 million. But if it's smaller than that, our fees eat up the savings, and it won't be a good thing. So it does take a larger asset sale. Okay.